Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. Today, I'm once again joined by my good friend, Doug Heagren. Hey, Doug.
Hey, Kirk. Good morning to you.
All right. Well, let's just dive right in here because we've got a lot of stuff. Last week, we had the CPI release, which was, I guess, a big deal. And it threw people for a little bit of a loop. It was a little bit off what people thought it was gonna come out. But this week, we wanted to dive into a bunch of updated data. I know we're a little bit delayed because we only have an hour each week. So, Doug, what do you want to start with this week? There's a lot to talk about.
Oh yeah, there's tons. There's tons to talk about, and I think one that'll cover. Of course, it's on everybody's mind because I venture to guess that everybody that's listening to this, or most people that are listening to this, are directly connected to real estate. And I think we've got some good information. We've been talking about real estate, but I mean, normally it's one of those things where people aren't overly concerned about. Just like, I'm not planning on selling my house, but you know what? These days, with a lot of the moves that have happened with the CPI, I think people are probably more focused and concerned about what's going on with housing than they have in years. So why don't we start there?
All right. Well, let's start with a few charts here. I'm going to run through a few and let Doug run through a few. So I want to start with one because we talk about the mortgage rate. Now, what's been happening with the interest rate market's been interesting because for this year, up until this year, everyone just looked at it as like, rates aren't going up, right? The market totally was not pricing in rates going up. And even though the Fed, even though the Fed talked about it for at least 12 months, the market was like, I'm not going to worry about it. Then January 2nd, the markets opened, and all of a sudden, rates started going up. The price of bonds went down, the price of equities went down, and everybody just threw a fit, as if no one knew it was happening. It's kind of funny in my mind. I think a lot of it has to do with year end. I don't want to say manipulation, but year end kind of pushing of assets, which right now we're seeing. Actually, we're not seeing the Santa Claus rally. So for all of you who are looking for that Santa Claus rally where the market just goes up in the last 2 weeks of the year, we're not getting it this week. I think the market's down like 1.5% prior to Friday, and so I don't think we're getting it. We're probably not going to get it next week. That's for sure. So, but I did want to talk about a few things. So one is, if we look at this chart, this is the 30-year fixed mortgage rate in the U.S. This is kind of the average rate. Obviously, it can fluctuate based on FICO scores and other things. But if you look at this, you can see as of January 1st of this year, we had about 3% thereabouts on the 30-year mortgage. Now, I know last year it went down to the almost 2 to some people, or 2.5, which is kind of crazy, but 3 is pretty low. And then throughout this year, it went to a high of 7. 7. I actually saw it go up to 7.5. But anyway, let's just say it was 7, right? But now it's down to like 6.25, which is a huge drop. Now, does that mean that rates are going to start plummeting? No, because the Fed is still raising rates. All this means is that from what happened last week when the Fed said they're going to start to I guess they said they're going to keep raising rates. So despite the fact that they only raised them 50 basis points instead of 75, everybody looked at it and said, all right, they're pivoting. Well, pivoting means you're going the other way. They're not going the other way. They're just moderating their increases, which, I think is reasonable. But what that shows is it shows that the mortgage rates are saying, hey, things are going to be lower in the future in 30 years. So the rates are going to go down. So it's great for people buying a home. However, I don't think you should. I don't think you should really hold your breath because at some point rates are going to go back up. But as we talked about in the show, things don't go in one direction forever, right? We've been beating the drum all year. Rates are going up, and they're still going up. But the 30-year mortgages aren't the Fed funds rate. So you have to understand that there's a relationship, but it's not the same. So if you look at this, so the 30-year mortgage is coming down, which is good. What I think is probably going to happen is we might even drop even lower. As inflation drops, most likely this rate's going to drop a little bit more, which is great for housing. But I don't think I don't think inflation's going to go below 5. I think there's just too much going on in the world. Right now we have the whole country of China, with 1.3, 1.4 billion people. They're all locked in their homes. Well, you're not going to have a whole lot of inflation when you've removed a good chunk of the world's population. But at some point, they're going to come out. They're going to unweld the doors and let people out, and they're going to start spending again. Well, what's going to happen? They're going to demand the same, access to the same amount of goods and service and resource that the rest of the world has, which means that prices are going to go up. So, in some sense, we're getting a reprieve because China's locking people in their homes. But at some point, they have to stop doing that. I know there was a house fire, like an apartment complex fire a while back, and then there's riots in China, and people are just fed up. So at some point, they're gonna say, "All right, we're gonna yield. We're gonna let you out." And things are going to go up again. So there's no rocket ship ride straight up. It's up and down, as you can see here. It's a stair step. So I think we're going to get a stair step down, which is good for buyers. But at the same point, I think it's just another leg in the step up. But the next 5 years are not going to be in a single direction. So you just should know that. And I don't want to be a two-handed economist here, which is on the one hand and then on the other hand, which is what economists are famous for. But, you have to look at this like I do think that rates are going to come down. Or let me reframe that. I do think inflation is going to come off and come down a little bit in the near future. But I do think it's going to go up further out. Just in the near term, inflation should keep declining. So let's talk about pending home sales. This is pending home sales. They're dropping through the floor. People are not buying homes because it's too expensive. And what's happening here is effectively rates have gone up. So if you look at the last chart, rates have gone up. So it's really expensive. We talked about earlier in the show from last year. Rates at 3%. You could basically afford half the house at 7.5% than you could at 3%. So are people buying homes? Well, they can, but they'll be paying twice as much in monthly payments, which people generally can't afford. The problem is you have buyers who can afford half as much. You have sellers who don't want to drop their price. So people aren't coming together, right? So if you think about buyers and sellers, they have to come together at the same price in order to agree, right? It's the same thing with the stock market. If no one's buying at this price, then it's not worth that price. Then the price drops until you find a price where it is worth buying. And this is what's happening with home buyers. Is let's say a home seller wants to sell for $1 million and the buyer's saying, "I'll pay you $500,000 for that." Obviously, they're not going to agree. The home seller's gonna be like, "You're silly. I'm not gonna sell this to you for half price." But the reality is that's what the affordability is 500,000. So until they get to a point where they agree, then you're not going to see houses going on the market. You're not going to see them buying and selling. Yes, we are seeing houses going on the market and getting sold, but for the vast majority, as you can see here, it's just dropping off the ledge because people just can't afford a house at the price that people are trying to sell it for. So, Doug, what are your thoughts on this?
Well, a couple thoughts. I want to go back to the mortgage rates because I think you still got that chart up there, Kirker. And so let's talk about that for a second, because I think one thing that's really important for people to understand is that there is not a direct correlation. Let's put it that there's a correlation, but there's not a causation between the Federal Reserve and mortgage rates. So, because one of the things people might be noticing is, wait a second, they're raising interest rates. Why are mortgage rates dipping right now? The Federal Reserve does not set mortgage rates. Okay, so there is a correlation there because the actions will have an effect on mortgage rates that based on what they do. Okay, so you won't see them completely impacted by it because there's more than one element. That includes your inflation rate, includes pace of job creation, whether or not the economy is slowing or shrinking. Obviously, the Federal Reserve's monetary policy is a factor too, set by open markets committees. Okay, so when you start looking at mortgage rates and why they might be dipping right now, well, again, if you have less people applying for those mortgages, and now we think, well, wait a second, if there's a demand on these mortgages, that would have caused those rates to go up. That didn't happen a couple of years ago because remember, all of these different variables have different effects at different times. So it's not just one thing or the other. But right now, if we start looking at expectations for the economy over the next, 3, 6, 12 months, we are most people would agree it doesn't look great, right? So if we look at the potential decline of the economy, the impact that's going to have on jobs, the impact that could have on inflation, because when wages get cut, and jobs get cut, that's a deflationary variable. When you start looking at the fact that people are not buying and selling homes, it's going to potentially have Again, an indirect relationship to those prices of those mortgages. And so, we're not going to necessarily see mortgage rates go lockstep with what the Fed comes out and states. And I think that's really important for people to understand, because I mean, it could be, we could find in the next 12 months, the the Federal Reserve has raised interest rates by another percent, and mortgage rates have dropped back down to 5. I mean, it could happen. It would be like, why? Because they're not directly impacted. But I will say it is critical, though, to understand how that does affect HELOCs. All right. So the federal funds rate, while there's an indirect link between mortgages and the federal funds rate, the Fed has a direct influence on the rates that are charged on home equity lines of credit, because those are adjustable rates. And those are linked to the interest rates on HELOCs are linked to the Wall Street Journal prime rate, which is the base rate on corporate loans by largest banks. Now, the prime rate in turn moves with the federal funds rate. And of course, the prime rate rose based off of the December, to 7.5% based on the December 14th, 22 Fed meeting. So I just want people to understand the difference there. So when you are looking at what the Fed is dictating in their meetings, and you watch what happens to those adjustable rates like HELOCs, if they raise rates, that's going to have a very bearish impact on the cost of acquiring an adjustable rate like a HELOC. But it may not actually in turn result in a rise in those mortgage rates. So also wanted to kind of go back to what you were saying on the available, or the pending sales. So I love the one chart that, that you've got a couple of charts on this, Kirk. The one I think is really important to look at is the one that Redfin put out, because I hear this, pending sales are down. I mean, it's December. This is a terrible time to sell a house. But what I love about this chart is it's showing a comparison of 2020, 2021, and 2022. And yeah, there's no question. There's a correlation of a peak in the sales of homes that are pending sales of homes in around June, July, the end of spring, into the beginning to latter stages of summer. They all dip off as you get into September, October, December. But look what happened to pending sales this year on 4-week rolling averages across the entire year. They never picked up. Now, we obviously, 2020 was an anomaly. You could see the gray line dips massively in April, May. Why? COVID, right? Everything just shut down. But as soon as everybody caught their breath, Kirk, and everybody was like, all right, whew, things started to roll back to normal, right? We started that the vaccine was going to be the cure. We're going to free things up. Lockdowns were starting to ease a little bit, at least here in the United States. And look, all of a sudden, it shot up. It basically delayed the inevitable, right? We went from an incredible trough of pending sales in May to to some of the largest pending sales we've seen in years, starting in, say, July into August. Okay, so it wasn't really the fact that people didn't want to move. It wasn't the fact that there weren't potential sales. It's the fact that it just stalled out for a bit, and then as soon as it freed up, all that stalled up energy, basically exploded. But 2022 started out a little bit better than 2020, right? Kind of lockstep with 2021, but it never got there. Look at the difference between 2021 and 2022 from the beginning of the year. And what has happened as interest rates have risen, as of course the correlation with the rise in mortgage rates, look at the incredible drop off that you start to see that happening sooner than normal in May. And all of a sudden, I mean, it's like a waterfall right now. It's just gone over a cliff, leading to, while normal years, yes, more, pending sales would be down this time of year. It's 33% year over year drop. I don't think it's a surprise to anybody. Money's expensive now, and you need money to buy homes.
Yeah, I couldn't agree more. I think, what's interesting about that chart, and I'm going to bring it up again here because I want to see which charts we have. So, yeah, so if you look at this chart, as Doug was saying, the most interesting part about this is not the direction, because they all go down in December. It's that things have dropped down 33% year over year. So pending sales have dropped 33%, in large part because of the rates. Now, if we look at this chart, which I think is really interesting, You compare it to the last chart. So the last chart was effectively pending home sales. This one is housing units under construction with 5 or more units, which is multifamily, right? So you're looking at apartment complexes effectively. Um, Now, if you look at kind of what's been going on this year, it's a lot more expensive for people to buy homes. So if you don't already have a home or if you have to move, you're in trouble because you're going to be able to afford a lot less than you did before. And so the house prices have to come down. But at some point, if people can't afford to buy a house, what do they have to do? Well, they'll rent, right? There's nothing wrong with renting. I know we have this stigma against renting, like, oh, renting is for poor people, or who wants to rent? We have this, American dream, and you have to buy a home, and you're not successful unless you own a home. Like that. I don't know if you know this, Doug. That was started by Fannie Mae. Like they're the ones that started that. That was a marketing campaign for people to buy homes.
No conflict of interest there, Kirk.
None whatsoever. There's no politics whatsoever involved with that. But the point was, is this is something that we weren't aware of. Most people aren't aware of that. It's the American dream was basically created as a marketing campaign. So there's nothing wrong with renting. And the fact is, if that's all you can afford, then rent. Who cares, right? If you have to rent for a few years, maybe rates will come back down. Who knows? I mean, I don't know the future, but I know that the numbers don't add up, so they're going to go down to where they were before. I don't think we'll ever. I hate to say never because things just tend to go in that direction, but I could say I cannot imagine a time where interest rates are going to go back to 2 to 3%. I just for mortgage rates, I just can't imagine that. Well, in order for that to happen, that would be an almost unfathomable event. Given the numbers that we see, right, and given the world that we're in, this twilight zone finance, it could happen, but there's no way it should. So anyway, the point being is this just shows that this is what people are seeing. They're saying, "Hey, I need to buy multifamily houses because the rents, everyone's renting. Like they need more units to rent out." So this is a sign of what we've been talking about. So I just wanted to kind of share that with you, and then also wanted to share this. This is the Home Builder Optimism Index. They don't look too optimistic right now, right? So if you look back in 2008, which actually started, it peaked out in 2005 and then went down until 2011, 12, before it started to pick up. That was a rough time for home builders. They were not optimistic at all. And then they started to pick up, and that was a good sign. 2020, also not optimistic because everyone's stuck in their home. They can't go out and buy. And people couldn't even, I don't know if everybody remembers this. You couldn't even list a home. You listed it, but no one would show up. So how are you going to sell a home if this actually was a big boost to the real estate industry where they started having virtual tours because people didn't want to show up. They were afraid of getting COVID. So they just had a virtual tour and they just had a camera and walked around the house. I mean, it was great. I'm surprised people didn't do that before. But at some level, I don't want to buy a $1 million house without actually having been in the house. You can look at it on a camera all you want, but if I'm not in there and I get a feel of, or even a smell, like maybe the house stinks, or maybe they're not showing everything on the camera, like all those little things. If you're spending that much money, you want to know what kind of house you're buying. So, I don't know that that's a permanent trend, but it's a great technology. Anyway, we're back to that place where we were in COVID. Home builders just are not optimistic, because of the prices, because of affordability, for so many reasons. So I think that, the wise, experienced home builders are sitting on their hands and have been for at least a year. And a lot of people I know, they've been doing nothing for the last year because the opportunity set just isn't there and they're not willing to make stupid deals just to get another deal. Now, a lot of the more inexperienced people, a lot of the people who are, let's just say, a little more questionable in ethics, I shouldn't say ethics, the oil and gas industry does the same thing where it's a boom and bust cycle. They just go all in, leverage all up in the boom, and then everyone goes bust, and then they have nothing left, and then they file for bankruptcy and they start all over again. Home builders, oil and gas are famous for doing this. And I don't know if it's questionable ethics, but I think if you've been through one cycle, you know better. And the smart people just sit on cash and they wait and they buy it all this stuff out of bankruptcy or foreclosure. So I think personally, this is a sign that if you're not wary about buying real estate, you should be. So, what are your thoughts, Doug?
Well, I think you have another chart going back to what you said about about the renting. So yeah, there's a chart that you have, Kirk, $800 homeownership premium, and it talks about when it was more expensive to rent versus when it's more expensive to own. And obviously, right now we're in a situation where, because of interest rates, we have a situation where it is going to be more expensive to own than it is to rent. So because of that potential, and it's no surprise that we're starting to see builder, if there's any building going on right now, that the building that's going to be going on right now is going to be multi-family rentals, because money chases money, right? If they think that's where the demand is, if they think that that's going to be where they can get the best return, if a builder is going to build a home right now, and reminds me of 2008 in a way. And I know that there's different variables at play here. We're certainly not at the same credit crisis we were, but it doesn't matter. It doesn't matter where the spark comes from, Kirk. The fumes are going to ignite either way. So we go back to 2008. It was, and I was living in Denver at the time, and Denver had Parade of Homes, and it was a sign of things to come, because it was the worst Parade of Homes I've ever been to anyone's ever been to in life. I think they only had like 5 or 6 homes. That's it. And they were these McMansions. They were huge and beautiful, but then you start looking at the trim of the homes, and you could see where they were, starting to cut some corners, some cheap things that were put in there. Well, as it turned out, only a couple months later, I think, and it made national news, that I think every one of the builders that had come to that Parade of Homes went bankrupt. They were all small guys. The big builders weren't there that year. That's why there was only about 5 of them. It was people that were trying to get into it. The economy had already started to turn. And obviously, we talked about this in a podcast the other day. They didn't do the research. They failed to monitor what was going on with the economy, and they lost everything going after this. And so right now, you're going to see that the people that are smart, that have been tested in these economic cycles, they're not going to go. I mean, it's just like retail. I mean, housing's no different. You need to be very careful. We talked about the bullwhip effect before. You have to be very careful building up too much inventory. It's as well as being careful not having enough inventory. If you are trying to sell homes and you don't have any homes to build and you don't have any ground to break, it's going to be hard. You're going to have a hard time selling those homes if you're going to have to go out and find the land to build them and build them to spec. You've got to have some things in motion. But at the same time, why would you go out there and build anything right now, knowing that we've seen a trend of a 33% year over year decline in pending home sales? Why would you build up that kind of inventory right now for the risk of having the capital now be put into the ground and the clock ticking on the return of that investment? And so you're going to see a real dichotomy going on here, because not only do we have a supply and demand issue, we're going to have, and that's going to be exacerbated by the fact that we're not going to have any new builds going into the ground. So as soon as that shifts again, where renting now becomes more expensive, because that's what's going to happen, right? If everybody stops buying, now you're going to have more and more people going to rent. It's going to be a wonderful short-term opportunity for those companies that are trying to rent those places out. They're going to be able to raise their rents up to a breaking point, because if we have an economic decline, guess who typically rents? People that are going to not be able to afford the homes, that are living off their cash flow to cash flow. And if that goes away, those landlords are going to have to certainly concern themselves with increasing vacancies. There's a risk. But if we've got all of these new builders jumping in and building more rents, more multifamily housing, well, then guess what we're going to have? You're going to have eventually an oversupply of those. Everything's cyclical. Everything's cyclical, just like retail, just like inventory. It's going to get to a point where the rents are going to have to come down, because they will invest. They will get to a point where there'll be too many places renting, too many vacancies. All of a sudden, nobody's buying housing. Housing has a shortage. I don't know where it's going to go, Kirk, but I do know that we've been here before. And again, We're seeing it again. And I think that as the economy softens over the next 12 to 18 months, you're going to see a massive disruption in the housing industry in both of these areas.
Yeah, no, I couldn't agree more. And I think I want to kind of move on from housing because we're going to beat that dead horse a lot on this podcast, and want to spread the love a little bit. So yeah, I think housing, we're going to continue to see issues. Housing tends to move slowly, a lot slower than any other parts of the economy, certainly slower than the stock market. So we're going to keep talking about it. But I think the trends, the trends tend to follow everything else. So I think you'll start to see housing pick up a little bit because rates are coming down, but not much because it's still really expensive in compared to what people want to sell it for. So until they come to that equilibrium, you're not going to see much more.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
I want to talk about a few other things here because there's here, let me bring it up here. All right. So there's a few other metrics here I want to talk about. So one is personal savings rate. So if you look at this, the top chart here, you have the personal savings rate, and you'll notice around COVID there was the first stimulus check, then the second stimulus check, then the third one, and then now the personal savings rate is lower than it was in 2008. It was 2.3 in 2008. It was 2.9. So historically, it's been a lot higher. It's been 5, sometimes up to 10%, but historically probably like 5 to 7. Now we're at 2.3. Why does that matter? Well, why it matters is because it shows how tight people are with their finances. So if you have extra money, you can save it. You can spend it too, but you have extra money you can save. When you don't have any money, you're not saving it. You're paying your mortgage, you're paying your electric bill. So what this shows is that people are getting really tight. And at some point, I don't know if that goes negative, but people are going to start to squeal because they can't pay their bills. And that's a bad sign. I mean, that's what we call a recession. When people go bankrupt, there's foreclosures, there's bankruptcies, there's all sorts of things that happen because the finances don't line up. So we talk about it a lot in the show. The best thing you can do right now is make sure that you're spending less than you're earning and have an emergency fund, have extra cash around just in case, and just make your financial situation more resilient. If you need help with that, give us a call, let us know. But basically, financial resilience is the number one goal you should all have. Even if you have a great job, even if you're making $1 million a year, it doesn't matter. Focus on being more financially resilient because we don't know what the next few years are going to hold, and we don't know how bad it's going to get. And, it's better to be prepared than not being prepared. And now you're SOL with your family's finances. So don't put yourself in that situation. You have time, not much, but you've got time to prepare. So while you're at the end of the year doing your planning, now's a good time to do that. And this is just a change in consumer credit. So it just gives you some understanding of how things are structured. Now, I also wanted to talk about, let me pull the other chart up here, personal debt carrying costs. Let's see. The reason I wanted to pull this up is similar. So this is the credit card carrying cost. Now, if you look at this, you have the red with blue circles. Obviously, the recessions are circled as it says, but the red is credit card carrying costs, which means that the higher they are, the more people are paying. Now, in the background, in that gray on the same chart, is the S&P 500. So it just shows in comparison how it compares to recessions as well as the index, and then consumer sentiment is at the bottom. Well, as you notice, consumer sentiment is quite low. But I think what you can kind of notice here is as the credit card carrying costs go up, there's a lot of liquidity in the system at these peaks, and then it falls off. And so if you look at what's happening now, right, the market has fallen off a little bit and the carrying costs have gone up. But if you look at the last 20 years, rates have been low. We haven't had the 70s and 80 and early 80s interest rates where they were over 10%. We haven't seen that yet. If we see that, you're going to start to see it skyrocket. Now, I know credit card interest rates are through the roof. I mean, the lowest rate I think I have that's probably more normal. I have one card that's really low, but normal is probably 15%. That's with good credit, no problems, 15% in this environment. That's crazy. I think the most I ever had was like 8 in the past 20 years. So that should tell you a little bit of something about, the state of the world, because if you have good credit and you're getting 15, and what are people without good credit getting? Well, they're not getting 15. They're probably getting 20, 25%. And, I might have to invite one of my friends to break some legs up here at some point. I don't know what that rate is, 25%, 30, 50, that's usury in my state, but the credit cards are allowed. They're exempt. You can't do it on an individual basis. Can't send my buddy down to break legs, but credit card companies are legal. So go figure. But that's what's happening is your rates are going up, and that's going to be a bigger problem for a lot of borrowers. So stay away from credit card debt at all costs, not because they're credit cards, but because they're variable. You want to stick with fixed debt. If you can refinance your debt, for instance, if you could take your credit card debt and put it into a fixed loan at the bank, credit card debt's 15, you can put it in a fixed loan for 8 at the bank, do it. You want to be fixing your rate, even though it's high. It could go higher. It's certainly lower than a credit card. So look at some creative ways to lower your interest rate. I think you'll thank me for it later, but try not to do it 1 year. Try to fix like a 5-year note or something like that. And that way, you know what you're paying. You're not going to get surprised. And quite frankly, don't cut up your credit card, but maybe put it in the freezer so you don't use it. So there's a lot of tools you could do. There's plenty of people out there talking about that. I'm not going to spend too much time here talking about that, but it's an important note. What are your thoughts, Doug, on all this? Because this is 101 financial planning.
Absolutely. It's not just credit cards either. And again, I agree with you. I think the only type of debt that should be considered right now is going to be a fixed interest installment type of a loan that has a definitive payoff, and that ideally is going to be deductible, but at least is going to be backed by some sort of collateral. Okay, where you have multiple ways to pay for it. I mean, the definition of being in debt, and I've talked about this before, is when you pay for something today, and the only way that you can pay it is through future income you have yet to earn. And that's a scary proposition when in many cases, you may not have that money that you can earn, especially if we go into a declining economy and layoffs start to pick up. This is going to be a disastrous situation for individuals. I think, on the other hand, if you have debt, but you have it collateralized or have other means, if you have more than one means to pay it off, it's a different situation, especially when you're not tied to these variable interest rates. But I also want to say, going back to good credit, you talked about, you asked Kirk, like, what's happening to those people with bad credit? So there's a gentleman I follow on Twitter, as a little bit of a plug, guys, at Guy Dealership, car dealership guy. talks about what's going on in the auto industry. He said right now he's got individuals who are coming in to buy cars with over 800 credit score that are getting loans for their cars at 8-9%. Okay. And that's just incredible. So here's what happens. Okay. So if you get a situation where he gets someone who comes in with a 560 credit score, they come into credit score, they come in to buy the car. They can't even sell you that car with that credit score profitably because the lenders are then hitting the dealerships with a bank fee that kills any profit. It's a lose-lose. So you're going to run into situations here where, yeah, I know, you remember the days, Kirk, where they said, no credit, any credit, bad credit, get it. Those days are gone. If you have no credit or bad credit, the first thing that you can work on right now is trying to figure out how to get that credit up. Get those debts off your books, because not only are they going to get prohibitively more expensive, but the ability for you to be able to have access to capital that you need for the things that you need. Let's face it, we live in America. Not everybody lives where you live, Kirk, where you can just say, hey, I'll just get a monthly token pass for the subway. We live in a world where most of America needs a car, right? Well, if you get to the point where you have run that beater into the ground and you need a new car, and now you can't go get the financing for it, now you can't get to your job. Some people say, well, just take public transportation. Not everybody has public transportation. There's a lot of parts of the United States that's terrible public transportation. So it becomes a snowball effect. If you can't get that car, you can't get to your job, you lose your job. Now you have no capital. Now you have credit. Next thing you know, you're bankrupt. Okay. Get your financial house in order and keep it that way forever. And now is the time to do it, because unfortunately, Kirk, again, we don't have a crystal ball, but there seems to be a lot of indicators that time is running out on those circumstances. And I want to switch now to something else too. Well, what about going back to access to capital? Kirk, I think you bring up another very, very interesting chart that we've got here. And it's the fact that, because I talk to people every day, it's like, well, I'm fine because we got plenty of money. And if you're in that situation, congratulations. But what does plenty of money mean? Well, it comes back to the argument of access to capital. If you're going to get that money, if you're going to get that money, where are you going to turn? Well, it's like if you got lots of money in the stock market, okay, you say, well, I'm liquid, I'm great. It's where I want to have this great rate of return. It's all about return. Well, here's the thing. If you wanted money tomorrow, needed money tomorrow, and the portfolio is down 20 or 30%, what are you going to do? You know that your advisor and your pit of your stomach is going to tell you, I don't want to pull that money out because I know that now is not the time to sell, which means that money is not liquid to you. It's not accessible. You need, and what happens if that happens over decades, or if that happens over at least years? And Kirk, you've got a great chart that talks about the impact of excessive equity exposure and lost decades for stocks. I don't know why there is this rhetoric that's out there that continues to say that the only place that you should keep money is in the markets, because you can get this great rate of return, and the S&P 500 is always going to get you 5, 8, 10, 12% a year. That is absolutely not proven based off of the real numbers that are out there. Now, maybe over time, on a secular standpoint, but on a cyclical standpoint, if you go back to the 1970s or late 60s or 70s, if you go back to 2000 to 2013, the markets were so volatile during that period that it ended up becoming lost decades. An entire decade where you got no growth. That is not a time in which you have flexibility of your portfolio to be able to use for the things you need, because you're waiting for that money to grow again. And that is, for some people, it's at least if not half your entire working years, it's a good chunk of it with no growth. And that means all of those dreams, all of those predictions you made, unfortunately don't come true. So this comes down to a basic premise of diversifying capital, making sure that you understand that you need to have money in lots of different places, that return is not everything in the conversation. But unfortunately, I think over the last couple of years, Kirk, of low interest rates, easy money, and just phenomenal, double-digit returns in the markets. There are people that have been through this before that forget what it's like because the further you get away from that experience, the less impact it has. And unfortunately, you got entire generations now who've never experienced it, have no clue, that seem to think that money just grows on trees. We are, as Kirk and I have talked about, we're in a paradigm shift. Investment allocation and asset allocation are correlated. They're not the same. Investment allocation, yeah, whether you've got stocks, bonds, private equity, whatever that may be. But asset allocation is having your money in different places, understanding some of it's for the long term, some of it allows you to have access to capital. This is probably going to be one of the most critical time periods, possibly for the next couple of decades, to make sure you put that financial house in order and keep it that way forever. Or else you'll look back and maybe a lot of the plans that you put into place won't come true.
Yeah, I think that's an important point, Doug. I think those are all great points. If, a lot of people, they don't think about their portfolio in the way that they need to now. For the last 20 years, everybody got lucky, I should say, or very fortunate that the markets pretty much always went up. You could buy the dip. There's certain quote unquote truths of the market that that just people espouse all the time. Oh, buy and hold, buy the dip. Oh, don't sell at the bottom because it'll come back, or bonds are safe. All these different things, and they generally work, right? Like they work most of the time. The problem is the last 20 years have been very forgiving, where they did work, and people just said, "Oh, they always work." Right? Like, oh, the Fed's going to bail us out. Here's another one. The Fed's going to bail us out. Okay, are they? I mean, they did, but are they going to do it again? Probably not. Right? They've explicitly said we're not going to bail you out. We're trying to force a recession or destroy demand, as Powell says, which means a recession. But I don't think people have caught on to what's actually happening with this paradigm shift. So if you look at this flows into equity funds, there's still a huge amount of flows into equity funds because people are just, if you look prior to COVID, it's not like COVID caused flows out of equity funds. COVID didn't cause that. COVID just dipped it a little bit. It was already going down. And if you look at what happened in COVID, everyone bought the dip and they made lots of money. But now things are starting to come off and people are still buying that dip. The problem is this is a different paradigm. This is not buy the dip paradigm. This is, you have to preserve your wealth. I mean, the markets, I don't know what they're down now, but at the end of the third quarter, we're down between 20 and 30% for pretty much any asset you wanted to hold. So that's a problem, right? So, if you look at, here's another, here's another piece, which is basically showing the household equity exposure as a percentage of total. Now, if you look at these peaks, people put the most amount of money in equities when they think the market's going to go up forever. 2000 and I guess, well, the real estate market's a little bit different, but you could see that fall off there. But you look where it was in 2020, same thing, peak. So I think what people need to take away from this is that we're in potentially another lost decade. You could call it that, I think, at least a decade. We talk about what the following decade looks like, and that probably won't be pretty either. But I think it's just instructive to look at these things and say, all right, what am I missing? Because I don't know the future, right? I'm just showing you charts. I'm showing you how to think about things. I'm showing you that there are excesses here that are not being talked about. And if you miss them, and when the market drops 50%, you're going to say, I had no idea. Well, sure you did, because we talk about it in the show. And here's some evidence that we might be entering in one of those periods. Do I know that for sure? Absolutely not. But like I said, I can't tell the future. But there are certain things that are truths you could argue, which is when assets get expensive, at some point they're going to get less expensive. Now that could be for one of two ways. So let's say you bought a stock today that's really valued at $10, but it's, the market's trading at $100. Let's just hypothetically say that. So it's 10 times more expensive than it should be. And you bought it, you way overpaid. Well, what that means is one of two things. Either the earnings of this company have to skyrocket to make that price that you paid worth it, or the price has to come down closer to that $10 level to make sure that it's reaching its equilibrium. Now, there are times where that equilibrium goes way out of whack one way or the other, up or down. And if it's if the price is a lot lower than what it should be valued at, that's a great buying opportunity. But when it's in excess, well in excess of what it should be worth or what it should be valued at, that's a time you probably don't want to be owning it. It's a good time to sell to somebody else. It's like right now. If I owned a ton of property, I would sell it all right now. I've already sold everything I own. I wish I could sell more than I own, but I don't own anymore. So, you look at these times and say people are willing to overpay. Great. Here, take it. I'll buy it back later at a lower price. Why would I overpay for something? So I think it's just important to recognize the signs and to understand this simple concept of what am I missing? So when I look at data, whether it's investing, or whether it's some puzzle, right? Or whether it's talking to a person, and I see something that's a little bit out of whack, right? It's just like, oh, the market's great, everything's fine. Then I see some data. I'm like, this data doesn't make sense. So I always ask myself, what am I missing? That's a question we should all ask. This is a mental model we can all use in our lives. You see something, you say, all right, this doesn't make sense. You should ask yourself, what am I missing? And explore that and try to figure out what you're missing. Maybe you're not missing anything, but you should always be asking yourself that question, because if you're not, then you're going to get surprised. The market's going to drop 40 to 60% like we've been predicting, and you're going to say, oh, I had no idea. Well, you did, because we've been talking about it every week in the show. And you might not have understood it, and that's okay. And that's why we have these live shows on Fridays, so that you can all ask your questions. And and certainly if you're not even on the live show, just send us an email, ask us the questions. We're happy to answer them. We're here to help. We're here to help you guys understand more about investing in the markets and help you be better investors. So you should always be asking yourself, what am I missing? Because I do all the time. I miss stuff every single day, and I look at something like this and say, what am I missing? Well, could this number go higher? Sure, it could go higher. Could go a lot higher for many different reasons, right? But if you look at history and say, all right, there's something here that's going to cause me to take a second look and say, all right, what do I need to look at here? And redefine whether I am off or whether this chart is off. And I want to throw a few more, and then I'm going to go back to Doug here in the interest of time. So I want to show this. This is a chart of the S&P 500 for the last 12 or so months, which is, I think, instructive because I think a lot of people, they don't really see what's happening. They just say, oh, the market's down or the market's up, but they don't really see the chart of where the price is. So you can see that the price has come down quite a bit this year, and it's gone up and down depending on what day you're looking at it. But overall, the trend has been down. So until that trend breaks, you should still expect that trend to continue, right? Just like in the last 2 years, the trend was up. Now the trend's down. So if you look at this and say, obviously the trend's down, at some point you have to say, well, when does that change? Well, we can talk about that. There's a lot that goes into that, but right now what you should know is the trend is down. That's the point I'm trying to make here. Another chart here is the dollar, right? The dollar has pretty much gone up all this year, in large part because we've been raising interest rates, and we have the safest currency on the planet, so to speak. And we've had rising interest rates ahead of many developed countries. So people were putting money into the U.S. economy, or they were basically buying dollars, if you will. So there's a lot of interest in dollars up until October, when the dollar sold off. We don't have time to go into it today, but the point is when the dollar goes up, it typically causes asset prices to decline. And when the dollar goes down, it causes asset prices to increase. That's not always the case, but I say it because currencies are relative. Everything's relative to something else. So, for instance, gold, which we talk about sometimes on the show, gold is relative to the US dollar. So I live in the US. So if I'm buying gold, I'm going to give somebody US dollars and they're going to give me their gold, right? And that's the exchange. So if I value gold more than dollars, then the value of dollars is going to go down, the value of gold is going to go up. Right now, gold has been rising, and we've seen that with the drop off in the dollar. So nothing more to say other than just keep an eye on the dollar. It's not a 100% correlated move. So if you see the dollar go down, you say, oh, the market's going to go up. Not all the time. I know a lot of people have been talking about this correlation because this year it's mostly held true, but it doesn't always hold true. So you just need to keep in mind it's another data point, another thing to look at. So that's kind of how I'd look at that. So thoughts, Doug, and then we're gonna get into one more lesson, then wrap it up.
Yeah, I think Kirk, you make some really good points there, and I think it comes down to something that I try to get a message out on at all times, but not everybody wants to listen, and that is that diversification is owning lots of different things that do different things at different times, which means sometimes what you're holding may not do very well, and that's okay. It's, you're not really diversified if there's something in your portfolio that you don't like, right? If you like everything you have, unfortunately, what's going to happen is eventually you're going to dislike everything you have. And then if you try to play that game of moving out of what you dislike to what you always like, you're always going to be a step behind. Okay. So you want to make sure that you're holding lots of things that do well at different times. So whether that's stocks, you were talking about how much the markets are down right now. I mean, I think some areas of the tech sector are down as much as 50, 60, 70%. I think that's some of the
Yep.
latest on Tesla's like similar to that. It's been brutal depending on sectors. But you want to own, if we're talking just stocks, you want to own different sectors. But you also want to manage outside of just stocks. I mean, a lot of people, as I said, have this belief that the only place that you should be is just buying an S&P 500 fund. And that's great as long as the S&P is doing well. But you should own stocks. You should own fixed income. Again, what kind of fixed income? That's something that needs to be managed. And once you start investing in things, don't get emotional. Make sure you're monitoring and making those adjustments. You should own real estate. You should own money, cash. Cash is a great asset class right now. Against everything else, it's making money. Precious metals. Start a business. Put your money there. Different kinds of businesses give you great tax incentives. Annuities. I like annuities because you know what? At the end of the day, what is life about financially? It's about having income, having something is predictable, protecting your income. If I say have a pension, everybody wants it. If you call it an annuity, people don't want it because it's just a label. It's the exact same thing. How about permanent life insurance? You know what? Things happen. People die. It's good to have, the ability to be able to be solvent for your family. It's the only thing that guarantees what you want will come true. It's not a need thing, but it also has incredible tax benefits. Taxes are going up. If you're afraid of tax risk, that's an incredible place to potentially put money. If you're afraid of interest rate risk, guess what? Nobody manages interest rates better than insurance companies. If you're afraid of market risk, again, so what you have is lots of people out there that'll tell you this thing's good, this thing's bad. The reality is nothing is good and nothing is bad as long as it's legal, right? As long as we're not talking about fraudulent things or we're talking about legitimate things that all have different benefits and different purposes at different times. And I can tell you, who feels the most secure in this, with what's going on right now, Kirk? The people that I know that have done that they have spread it around, that they realize that the game of wealth is like playing golf. Okay. You need clubs to play the game. You can't go out and throw the ball. First and foremost, go to the driving range, work with an instructor, get the right game plan in place, get your swing right, because a bad swing, no club is going to fix a bad swing. But once you get out there on the course, you need different clubs. Nobody plays 18 holes with a driver. Nobody plays 18 holes with a putter. Nobody's going to try to use the putter to get out of a sand trap. Sometimes you're not going to use those clubs in your bag, except every 20 rounds. But does that mean you shouldn't have the club in your bag? Absolutely not, because when you need it, it's there. So I think the key is having your money working in different ways at all times is critical. And unfortunately, people lose that because they get caught up with the new shiny thing or chasing the fastest dollar. And unfortunately, when we head into these paradigm shifts and situations like this, which occur time and time again, it ends up being disastrous.
Yeah, I appreciate that, Doug. So we're gonna wrap it up with a lesson here, and then we're gonna send everybody on their way for the holidays. So here's the lesson. It's gonna come in two parts. This gets back to our half truths. So this is something I see a lot. If you're on LinkedIn, if you're on social media, Twitter, you're going to see a ton of these charts, and it's going to show an overlay. This is what we call an overlay. So take some other year, and for those of you who are listening in, you can go to YouTube or LinkedIn. You can catch the video of this. But basically, it's a chart of the 2008 market crash versus today, and so it shows 2008 versus 2022. Well, you'll notice, wow, there's an awful lot of similarity between 2008 and 2022. Oh, and it looks at today, which is right before a market crash. oh, well, it must mean the market's going to crash, right? Because there's so much similarity. No, there's a difference between correlation and causation. Now, correlation is something that this is showing. It's showing that there is a correlation between 2008 and 2022. But what was the cause in 2008 that caused the market crash? Well, it was Lehman Brothers, it was Bear Stearns, it was the financial industry imploding, all sorts of reasons that imploded that have nothing to do with today. I'm not saying it won't happen, but I'm not seeing anything today that says, wow, the market's going to implode. I'm just not seeing it, right? There are plenty of reasons where the market should drop, but I don't see it crashing. And so if you look at this, you can come to the conclusion because this is what it's showing you. It's showing you a narrative. It's not showing you the truth because unless this person can predict the future, they don't show you the truth. They're just showing you a narrative that says, wow, the market's going to crash because it looks so similar. I see this all the time. You should pretty much ignore these. They're interesting, but if you start getting swayed by this chart and thinking the market's going to crash, you need to short everything. It's just a great way to lose money. So don't do it. So don't look at this chart. You can look at the chart and laugh and say, "Oh, that's a nice chart," and move on. Okay, and I'm going to do that. I'm going to move on.
And Kirk, I want to say one thing about this. It's really important to remember. Even if you have total conviction of a shorting, and The Big Short is really exciting as a movie, and there's some people that have the stomach for it, but listen, a crash has limited loss. Okay, a worst case scenario, it can go to zero. Shorting has unlimited loss. There is a potential for you to lose in an infinite amount because as long as the market goes up, you continue to lose more. So the most dangerous game you can play in investing is shorting. So, and I don't recommend anybody get into that game.
Yeah, I appreciate you sharing that, Doug. And all right, so we're going to move on to the next one in interest of time, which is something we should have had on our energy episode, which now I saw this a lot and certainly heard plenty of politicians talking about this, mostly just to fire up their base. But what was being talked about was this. So this shows 50 U.S. oil companies, and it shows cash flow, and it shows capital expenditures. Now, not to get too much in the weeds, but basically what it means is if you have a business, it will spin off cash flow, if you're profitable, assuming. So it spins off cash flow. And with that cash flow, you can decide to do multiple things. You can decide to pay it out to shareholders, which is what we call a dividend. You can decide to reinvest in the business, which is typically capital expenditures. You could keep it, you could reinvest it. There's all sorts of things you could do. You could pay down debt, but what oil companies have to do as part of their business model is they generate a lot of cash from their operations. But then they have to take that cash and reinvest it back into future wells. So if they're drilling a well, it produces, let's say they spend $1 million on a well and it produces 10 million. Great. Well, they need to take $1 million, let's say, and reinvest it back into another future well, or else in the future, they won't have any wells. Now, what's happening is, as we mentioned a few weeks ago, in part because of the green movement and global warming and all that, and I'm not judging, I'm just saying that there's a big movement globally to reduce carbon emissions. And the point is what that is doing is that's telling the oil companies, hey, you should not be reinvesting into carbon energy. Yet our whole globe runs on carbon energy. So if you just stopped it next year, we'd go back to the Stone Age because everything runs on it one way or the other. So the challenge that we face is looking at this chart. And anytime you hear somebody say, oh, especially politicians, and I really hate this, but anytime you hear a politician stand up and say, oil companies, we need to tax them, excess profits tax. It's not excess profits. They're making the same amount of money. They're just having excess profits because they're not reinvesting into their infrastructure because the politicians are telling them that they shouldn't. So see a problem here? See why politicians cause the problems? They're telling them, you reinvest in this and we're going to tax you. We're going to do all these negative things and we're not going to support you. So they say, all right, we're not going to reinvest. We'll just pay it out to shareholders. Oh, you're making too much profit. We need to tax you more because you're making too much money. It's a ridiculous cycle. It's basically penalizing the oil companies for doing their job. And their job is powering the world, cars, infrastructure. It's powering the world. So you're basically telling them, stop powering the world. And then the politicians, when it becomes a problem, they're going to say, I didn't see this coming. I don't know what happened. This is a cycle that it affects every single issue. This is not just oil. I use oil because it's so obvious and there's numbers and it's visible, but this impacts a lot of different issues. So you just need to understand that anytime you hear something, don't just emotionally jump and say, yes, they're making too much money, we need to tax them. If you're one of those people who thinks that people should pay more in taxes, this is not one of those things where you say, oh, well, they should pay more in taxes, they're making more profits. This is one of those things where you should say, you should probably invest more in the infrastructure because at some future date, we're all going to be screwed, which was the point of my episode a few weeks ago. So just understand the dynamics of what's happening and why. And you've heard me talking about this in the show for months about all these different challenges. And you know what? We tend to be a little bit ahead of the curve. And this is one example. I don't create charts. I'm not sitting around creating charts out of the blue. I'm literally out there finding stuff. So we've been talking about this for months. Now somebody's finally putting this out there and saying, hey, actually, it's the EIA, which is one of the organizations you should probably follow. But if you look at this chart and say, wow, people have finally come out and realized that this is a problem, even though we've been saying it for months. So we don't always have the chart short away, but we will tell you what our thoughts are and how we see the world. And magically, the world kind of comes around to our thinking eventually because we try to explain the world in a lens, not that we can predict the future, but if you look at it this way, things will be much more clear. So we're going to wrap it up here. And final thoughts from you, Doug, as we wrap it up.
Yeah, so there's another group on Twitter that I like. It's Amazing Facts, and one of the things they posted was today there's a term for an inept politician. It's called a throttle bottom. Now it's kind of a redundant term because if a throttle bottom is an inept politician, and as we seem to feel all politicians are inept, seems like that's a little redundant on the definition. But basically, what you're talking about, Kirk, is throttle bottoms that are coming out there and spewing a bunch of stuff for political reasons that has no real effect or benefit to anybody. The other thing about business is, and again, economy, and this is why we're seeing a fundamental paradigm shift, is with low interest rates the last several years, what did we run into? We ran into a situation where many people or many companies were able to just get money in order to grow. And we talked about that on another gentleman you talked to, Kirk, mentioned this as well, is that even some of the venture capitalists, they want companies that don't make profits. They like that. How fast can you grow if you're profitable? It's a negative thing. And they talked about a dividend, or the ability to have a dividend or pay yourself a fair wage as an owner is a really good sign of business health. And the reality is that we're having a paradigm shift where that money's not available anymore. These companies that are just growing for size, that need lots of funding to do that, there's no funding available. The companies that actually now are primed well are like you're mentioning with these oil companies. They have lots of capital, and that's a drag, and lots of capital equipment, and that's a drag during times of free money. But right now, they can sit back and they can decide, because it's already in the ground, how much they want to explore, how much they want to invest. They're still collecting the dividends off of what they've already produced. And as long as oil rates, oil goes up, they're going to make those profits, but it is not because they have raised prices on people. So I want to tell you where you can find more about me. One thing you said earlier was talking about looking for a house, right? If you're going to find a house, you should take a look at it first, not just buy it online, because that might not be showing you everything you need to know about whether or not that's going to be comfortable. It's the same with college. Okay. Problem is, people make emotional decisions by college just walking in and falling in love with it. The reality is, just like a house, do the logical decisions. Make sure it's the right fit academically. Make sure it's the right fit financially. Make sure it's the right fit socially. After that, absolutely get emotional. Go visit it and make sure that it feels right at that place. But don't make sure it feels right until you know it's the right fit for you. Unfortunately, not doing so costs people tons of money. We know there's a debt problem with college tuition. We know that people overpay for a mediocre experience. It doesn't have to be you. Learn more at ProCollegePlanners.com. We have an entire process and solution to help you find the right college at the right price, your ideal college, academically, financially, and socially. ProCollegePlanners.com.
Great. Well, Doug, I appreciate you coming on the show once again.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.